Welcome everyone to this month's installment of the Intentional Success webinar. I'm your host, Tom Stimson, and I'm going to entertain you today by talking about fiscal budgets and why they're more important than ever. We've been through some big changes the past few years, and we seem to be back into a pretty hot flow cycle and everything seems to be clicking along. But that's why this budgeting discussion is so very important right now, because our markets are behaving differently, our balance sheets are behaving a little bit differently, our revenue looks different. You're probably making more money than you have in many years. So having a good grasp of your numbers and knowing how to look at them and interpret them and work with them is vital. And it's probably, I'd say 9 out of 10 companies that I take on as clients don't have a very well developed approach to reviewing their financials. Some don't look at them at all. And if they do, they don't really know what to do with them. So I want to elevate our discussion about all of this and give you some better tools so that you can adapt your financial review and your budgeting and your forecasting methodology, adapt what I'm going to teach you so that you could have much more intentional success with your numbers. For those of you who are new, I'm Tom Stimson. I'm president of the Stimson Group. I work with owners and management teams of pretty exclusively for companies in the live events industry. It's a great industry. It's a lot of different verticals in there, but we are primarily the folks that produce and put on events from the technology side. So this is my space. You're my people. I'm always grateful that you are here. This session is being recorded, and I will double check that right now because I don't want to give any refunds. Questions, always welcome. Post them anytime. Please use the Q&A box. So click on the Q&A tab. If you have a question about the content, I'll see that. If I can weave that question in at that time, I will. There are points where I'll pause and take questions, and of course, questions at the end always. Chat box. Introduce yourself to other people online. Say hello where you're watching from today. If you're looking for some help on something, doesn't hurt to post it in there. See if there's somebody who can reach out to you and give you a hand. It's just take advantage of the community, will you? So I want to teach you how to set up a budget and a P&L statement that you're going to actually use and look forward to using every single month. I want you to be excited at the end of the month to close that month out and sit down and review the numbers and see what you've learned from it and celebrate your successes and see the results of the things that you've been working on. Once you understand how it's all interconnected, it really does become a whole lot of fun. And trust me, your management team would like to be involved in this. They want to know what's going on and how they're having an impact and where they can make a difference. And I'm going to show you how to do this. Okay. Now, why? Well, I want you to have more productive management meetings, right? Your management team is the lifeblood of your business. You need to keep them engaged, involved. You've got to give them good tools. And this is probably one of the most important tools that you can give them. I want you to have data at your fingertips, but more importantly, I want you to have actionable data. I want you to have data that you can put to use right away. I want you to be able to create goals that are not only achievable, but you can see the results on a monthly basis as you work towards them. And I want you to know your numbers, and you need to know your numbers without losing your mind. You don't have to be buried in numbers, but you need to have a good sense that if, hey, we're going to have a $900,000 month, here's the results that we should expect to see. And here are the factors that might make it better or worse than that. And being able to approach this much more from an academic standpoint instead of kind of guessing and hoping how things will turn out. You need to know how things are going to turn out and have a pretty good understanding how all of this stuff works together. And I'm going to try and help you do that today. So the goal for this webinar is for you to have a productive monthly review of financials where you get good information. It helps guide you about decisions and choices and priorities going forward. So we're going to focus only on the P&L today. Obviously, you've got a balance sheet and statement of cash flows and a whole bunch of other financial stuff, but we're going to focus on the P&L and the budgeting forecast for that P&L, which is basically a pro forma P&L going out into the future, and how that's going to help inform us today. I'm going to be showing you a budget forecast template. It's in a Google Sheet. When the webinar is done and we post the replay, I will share that link with you so that you can also access that sheet, copy it, study it, adapt it, do what you want with it. And it has it has 3 elements to it. It has a master data sheet, which is where we do updates and we combine the forecast and the actuals together. But then we also have a monthly review sheet, which consolidates that data and gives us that snapshot, that dashboard that you want to see. And all of this builds off the annual budget forecast, where we look at the coming year and say, okay, based on what we know and what we want to do, here's how those results are supposed to play out. And we want to balance these 3 things. So I've put them all together in one template for you. Connected them. It's not a perfect spreadsheet. It's got a lot of interconnection in it. There's got a fair amount of sophistication in it. It is by far not the most complex version of this I have ever done or I have ever seen. This is accessible, and most of you are going to be able to use this without too much trouble. So let's kind of dive right in. I'm going to start by not putting it all together for you. I want to show you the end result. I want to show you a monthly report, how to look at it, what the numbers look like, what we're comparing. In other words, what's the point of all this? Well, we want to have a good, productive financial review of a month. So what does that look like? Now, there are 3 key concepts in looking at a P&L statement, profit and loss statement, or an income statement, that I want to remind you about. One is that the ratio of revenues of the different types of revenue you have are important. Spoiler alert, if your P&L statement has one line for income, you've got a problem to fix. You need to unpack that, because you have many different types of revenue. They affect your cost of goods sold differently. They deliver different gross profit. We've got to break those things down, and you'll start to understand why as I walk you through all of this. So when I'm looking at the 5, 10, or 20 types of revenue I have, I'm interested in the ratios between those. 100% of revenue is your total income. Maybe 50% of it was equipment. Okay, maybe 40% of it was labor. These numbers matter because you have trends and you have norms. And when your numbers go wonky or you get a result that you didn't expect, this is actually the first place I look, because if you had a change in your mix of revenue, it's going to change your outcomes. And that's always the first place to start looking. Another important concept is that your cost of goods sold is always looked at as a percentage of revenue. The dollar amount in cost of goods sold is irrelevant. It does not matter, because your costs of goods sold are costs that you incur because you sold something. The percentage of cost of goods sold to what you sold is what matters. So if 50% of what you sold was labor income, and your cost of goods sold for labor was 60% of income, you know that you spent more on labor than what you sold, and that should be a big red flag. So the dollar amount, oh my goodness, look at our labor bill this month. Well, that doesn't matter. What was the labor as a percentage of revenue? Because that labor bill may be perfectly normal for the type of month that you had. And then the third concept is that the percentage of revenue for your overhead expenses, what we call below the line, below the gross profit line, doesn't matter. Right? Your rent does not change if you have a big month. So the percentage of rent to revenue is absolutely irrelevant. Typically, what I will see on management team reviews is an income statement that either has no percentages next to things or percentages next to things that are the same. So we look at those percentages and it's like, well, wait a minute, does this matter? Well, it does if it's in cost of goods sold. All right. I'll mention accruals. If we have time to talk about accruals, we will. I got a little ahead of myself. I got a little bit over the reins on that. But accruals are fun, and putting accruals in revenue, I mean, in your overhead is great, especially when you get to the end of the year and you've got all these little presents that you get to open. But we'll talk about that if I can fit it in. All right, so that monthly report, I'm going to share a new screen, and I'm going to show you this sheet. All right. And again, you're going to get this sheet. I'm going to give you access to this. I'm going to share this link with you so that you can play with it as well. Right now, I just want you to focus on what I'm trying to tell you. So I am looking, I'm sorry, let me get this to the monthly report. There we go. Here's the monthly report for September of 2022. So the management teams come together and we're going to look over this report, and we're going to start with income, and we're going to see we had a $680,000 month. Maybe good or bad for your company, don't know, doesn't really matter. However, I will point out that for this company, they had budgeted 1.1 million. So I'm going to kind of go on the premise that this is not a really good result for them. They missed the mark by a substantial amount. But here's what I was talking about of revenue breakdown. 40% of what they sold in their $680,000 was labor sold. And then they've got equipment rental, which, by the way, is always net of discount. So you take the discount out and you post the actual rental amount, not the retail amount. And we're breaking down their billable expenses, travel, logistics, expendables. You may have others, you may have more. And adjustments to income, which is accounting stuff. It's mainly to do, credits and things like that. When you have to give some money back or that sort of thing. So what am I going to analyze here? Well, the first thing I want to analyze is the fact that, this is not a good number. So what went wonky? Well, we probably know from looking at our jobs, which job fell through or what happened. But something that jumps out at me is the big shift up in labor sold over what the budget is. And matter of fact, if I go down to their current year to date, because I have all this other data over here that's going to help me verify questions that I'm asking about the current month, it's off. We regularly run 35% of revenue for labor sold, and here we are at 40%, which I would argue is probably a good thing. But if you didn't plan for it, you didn't expect it, it's an unusual outcome. So what does this mean? It probably means that a huge piece of rental left a job, but the labor stayed. You did a job that was heavy labor. Maybe you helped somebody out. There's a lot of things that could have happened in all of this. More than likely, it's one job fell through. This is basically one big job apart from their budget. It doesn't tell me the whole story, but I've got some clues and I know what I need to look at to find out what's going on. So the budget month, 1.1 million. The year-to-date results puts them at 7.8, but their year-to-date budget is 7.6. So they're ahead of budget, which is good. That's nice. And they're not significantly ahead, so they weren't sandbagging it too much. That's great. They're forecasted to get to 11 million, so we can't have any more mistakes because that's a lot of pickup between now and the end of the year that they've got to pull off. If I look at the trailing 12 months, which is, in this case, would be October of 21 through September of 22. So I'm always looking at an entire year, which is very important in the seasonal industry because I want to get all the rounding errors and all the seasonal anomalies into an entire year. So we know that you have some slow months. If I'm always looking at 12 months, I capture those slow months and I get a picture. So if their trailing 12 months run rate was 9.6 million, and they're still expected to do 11 million on this, there's a fair amount of pickup in there. I bet if I went and looked at their October or November numbers, there's something huge going on there. And I hope it comes through for them, right? I can look at where we were this time in the trailing 12 months or the total 12 months for the prior fiscal year. So the prior fiscal year, which would have been 21, they did 10.5 million. Their trailing 12 months is 9.6. They're actually running behind their previous year. So again, a lot is banking on this forecast and whatever big thing is hiding in the next 3 months. Now let's go down into cost of goods sold and let's see how we're doing with this money that we brought in. I'm very big on having, if I sell labor, I want to have labor and cost of goods sold. And I want all the kinds of labor and cost of goods sold. So you have inside labor, you have outside labor, you have inside labor overtime. The reason I separate inside labor and overtime is I want to see the variable cost, because overtime is a true variable cost. Inside labor is generally a fixed cost because you got salaries or base hours, and maybe a number that doesn't move that much. It just depends on how you pay and what your pay cycle is. So this gives me a little bit of information about what's normal. Well, inside labor as a percentage of revenue, obviously it's up because, well, our labor revenue was up. So again, it's not going to track with our historicals because we know this month is being a little bit wonky, right? We see what our sub-rental normally is. Our sub-rentals are actually down, which is an indication that we did less equipment work that month, which supports the idea that there was a big labor piece on some of the jobs that we were working on. Turnkey services, or I call it brokered services, are things where you go outside and you hire equipment and labor together and you can't separate the two. So it's part sub-rental and it's part labor. Rather than break them apart, I put them in together. For instance, if I hired a generator with a generator technician and they got bundled together on the invoice, I was put them into turnkey services. I break out all the travel expenses, which is very handy because if I want to go see what's going on and say, oh, wow, you know, what is normal for my travel expenses? Well, it's usually running about 4.6%. And here my travel expenses are running at 3.7%. So, oh, hey, travel expenses are down. Maybe that's a good thing. Logistics, we break out the parts and pieces of that. Anything that I'm going to resell goes in there. Miscellaneous equipment and supplies that we buy. This is stuff that you buy that you might barcode it, but you're not going to capitalize it. So what we end up with is our total cost of goods sold and our gross profit. Well, our gross profit is down as a percentage of revenue for reasons we've already talked about. One, it's a month where we don't have enough revenue. Two, our mix of revenue is not ideal. If our budget month was ideal, which hopefully it should have been, you know, this is a company that should have been doing 55% gross profit. And historically, you look at how they've done, that's very reasonable. So there's some problems in this month, and this tells us to look at it. Now, when we get down to the boring stuff, expenses, and this is the below the line. When I say below the line, I'm looking at the expense line down. It's all the stuff that's pretty boring and static. Now, notice, while these do have a percentage of revenue number on here, I remind you that it's irrelevant. It doesn't matter. If sales salaries are $60,000, of course, the percentage of revenue is going to be higher this month because revenue is less. So this doesn't matter. It's just here because it's here. And you will find that in most reports you generate from QuickBooks, if you ask for percentages, it's not going to distinguish. It doesn't tell you whether or not this is a useful number. It just puts it there because you asked for it. So I'm not going to focus on that. However, if I come down a line here and I see a number change significantly, from what was budgeted, now I might want to do something about it. Now I'm interested in what's really going on. In this case, we don't really have anything jumping off the page other than the sales commissions, but we know sales commissions are tied to revenue. So of course, sales commissions are going to be less than what the budget are. All right, then we get all down here and we get our total expenses, which is really fairly consistent. It's not a big anomaly, 350,000, 335,000, not a huge difference in the big scheme of things. We have a negative profit from operations. We don't have any operating adjustments, so we have a negative net profit. We had planned on a positive profit. All right, management team, what's going on here? What do we want to do about it? What do we need to fix? Well, now we have something we can talk about because we can see what was expected. We can see our histories and our trends. And we have a lot of good information here for us to start thinking, putting our heads together and saying, well, was this really just a revenue problem? In which case we can just focus on revenue. I'm not seeing a lot of problems here other than the revenue problem. We didn't have any huge anomalies in expenses. So I'm hoping this is just a revenue problem. We can get some answers to it and we can move on. All right, moving on to that. So how did we get that monthly report? Okay, where did that thing come from? Hang on. All right. So I told you there's an annual budget forecast. Okay, we're going to take a look at that next. It has all the assumptions there, and it's based on data that you have, goals that you're setting, and a little bit of educated guessing, because there is a little bit of voodoo in forecasting. I'm going to encourage you to update it often, because updating it is important. You don't create a budget. There is a school of thought that says you create a budget and you never touch it. And you either under or overperform on it. I don't agree with that. When I have actionable data, it should affect my forecast. Okay, when I am smarter, I should make my forecast better. And as you get better at forecasting, your forecasts become actually more and more useful and more reliable. And bankers, by the way, love that stuff when they're trying to give you a loan. So there's a historical data in the master sheet, which I'll get to after that, after we talk about the budget forecast. Big thing here is getting your data out of QuickBooks. Data in QuickBooks doesn't do you a lot of good. You can't do a lot of things with it. QuickBooks is not set up. No accounting software is really set up for the kind of analysis, unless you're in one of the really big packages where you can do a lot of really customized reports. You know, I'm an old Crystal Reports guy. You can create some great reports. But if you're a QuickBooks user, like 90% of us are, export that stuff out of QuickBooks into Excel or whatever it is that you use, and manipulate that data there, right? You can get a lot more information and do a lot more things with that way. So let's build that budget forecast and find out, well, how do you know you're going to have a $1.1 million September? Oh, and then miss that number, right? So to create a budget forecast template, the first thing that we're going to have to do is we're going to have to learn how to formulaically break down our revenue. Remember, I looked at revenue as percentages of the whole. 35% is a normal amount of labor for the company in our example. 45% is a normal amount of net equipment. 4% is logistics, 3.7%. All of those things are normal. So if we had $1 million month, we know exactly how to break that down, that it's going to be $350,000 in labor, $450,000 of equipment. For then, we also know that you have an average cost of goods sold for each type of revenue. For instance, if your net equipment is $450,000, that's going to tell you you're going to have approximately X amount of sub rentals on a month like that. So that cost of goods sold percentage gets calculated in your forecast, that if we expect to have $1 million month, I also expect to have, $90,000 worth of sub rentals, whatever that number might be. You will find that most of your overhead spending is consistent, except when it isn't. Okay, there are a few items that are timed, or they are tied to revenue. As we saw, commissions are tied to revenue. Payroll will also mess you up here. If you do bi-weekly payroll, there are, several times a year where you're going to have an extra payday in a given month, which throws all of your numbers off. There are ways to get around that. I'm a big fan of bi-monthly payroll. Pay on the 1st and the 15th, and you've solved that problem. All right. All right, so let's take a look at this forecast sheet. A new share here. All right, so we're coming out of the monthly report, and we're going to look at a budget forecast. And here's how we set this sucker up. First of all, you will see there's a lot of columns in here, but there's a reason for that. But each month of the year, 1 through 12, is all up here. All right. We have an estimated income column, and just to show you how this works, okay, it changes the numbers, right? So if I change this number, okay, then the labor breakdowns are going to change, the cost of goods sold are going to change, because what you're building up is a dependent formula spreadsheet. And how do we get to all those formulas? Well, revenue is easy, right? We know from our historical what our revenue breakdown is. And if our revenue breakdown on labor is 35.5%, that's great. I just create a formula, boom, there it is. I can change the amount of revenue on any given month and the numbers will change. Many of you already know that there's a difference in what these ratios will be between a $2 million month and a $500,000 month. The ratios don't hold up. They are not that tight. We will get there. That's advanced. Okay. You can figure that out on your own, and we'll talk a little bit about how to make minute adjustments as you go through this process. But we know in general that we can start from this. So I can now extrapolate what my revenue breakdown should look like. Now, when I get down to cost of goods sold, okay, we know that as a percentage of revenue, we have data that says on the average, our cost of goods sold for labor is, 28% of revenue. But that wouldn't have worked in the monthly report we just saw, where labor revenue was a little bit off. So when I develop the forecast template, rather than using the percentage of total revenue, I actually, and you'll see it here in the notes, is I build the budget based on a percentage of the revenue item that affects it. For instance, outside labor is 40% of labor sold. So on the average, when I sell labor, 40% of it we have to hire outside to do. So I only measure that against the labor sold. Equipment doesn't affect outside labor. Travel does not affect outside labor, so I don't need to mix all of those numbers in there. I'll get a more accurate picture of what's going on. If I happen to have a month that's really heavy on labor, my forecast is going to track. If I have a month that's really low on labor and really high on equipment, my forecast is going to track on my cost of goods sold. Subrental is tied to equipment. I know that, and as I have done for years, I look at subrental as a percentage of revenue, and I know that on $1 million month, we're going to have 9% of revenue is going to go to subrentals. However, it's the equipment sold that affects this number. So, and obviously we are looking at a discounted number, so there's a little bit of mushy numbers in here, but in this particular model, the subrental number is 14% of equipment sold. Per diem, 15% of travel sold. Again, this is all based on this company's historical data so that we can get fairly close on what the numbers are going to be. And that gets us to our 45% cost of goods sold for total income. Expendables, we mark things up 100% for that stuff, so 50% cost of goods sold, right? So you've got this data, and for instance, if you had a month knowing that you're going into month 4 and you have a job that has a huge amount of trucking in it, you might go in and change these numbers, okay? You might go in and change this number, the logistics number. In other words, you can say, no, on this particular month, it's going to be higher, and I can force in some new numbers here. So the more data you have, the more finite you can get with your forecast. But on your first draft, let's just line the data numbers up the way that we know they will work on the average over the course of a year, and then you can come back later and do the fine tuning. So I've figured out how to calculate all my cost of goods sold. I got my revenue breakdown. Expenses, again, below the line, are typically fixed, right? However, if you know that you are hiring a new salesperson in the second quarter, you might increase that number there. If you know that, you're going to pay out bonuses in the fourth quarter, you can put that number in there. So the more information you have, the tighter you can make this. But effectively, what we want is everything below the line to be boring. So let's put those numbers in there, make it as boring as we possibly can, but let's be realistic about what's going on. Depreciation, many of you don't calculate depreciation until the end of the year, and your accountant tells you what it is. If you know what last year's depreciation was and you know what equipment you're buying this year, you can put in a depreciation number for this year. It won't be perfect. It doesn't have to be. It has to be relatively accurate, and you can adjust it as you get better data. So again, you can put all these numbers in here, not a lot of variables, and looky there, this is a company that, we really want to do a good year. If we get to the end of the year here, let me scroll way over, they're budgeting a 16.87% net profit for the year. Now, as their consultant, I'm going to tell them to go back there and sharpen their pencil and get that up to 20% because this isn't good enough. They're leaving a lot of money on the table. They're not controlling their costs. They need to fix some revenue. The beautiful thing about forecasting and budgeting a forecast is that you still have control over everything. Okay. The most important thing you have control of is your goals. So set a higher goal. It does not take a very much effort at all to squeeze out a few more percentage points on this budget. It really doesn't. Now, how would I do that? Well, since this is my draft budget, I'm going to come back to the team and say, well, guys, what can we do here? Well, somebody will point out that we have an awful lot of inside labor. Our utilization isn't great. And if they're on shows, they're making overtime. We could probably not hire the 2 people that we need to replace or the 2 open spots that we have, push that to outside labor and get a better margin. And that picks up 2% of gross profit. Okay, you're halfway there. You're halfway to your 20% goal. So we can look at these things. Our sub rentals have been running a little bit high, and it's because there's some equipment that we haven't been buying. Well, maybe we need to invest in that equipment and get those sub rentals down. So there's lots of things you can do here. We've been overbuying on airfare because we accommodate everybody's whims about which airline they need to fly and, paying for extra baggage and stuff. And maybe we just need a better policies in place so we can get control of some airfare costs. So there's lots of things you can do here. I'm sure, how are you going to deal with your logistics costs? Maybe they're a lot higher. Maybe the problem is we can't fix the cost. Maybe the problem is we need to fix the revenue on logistics. So, okay, let's make a committed effort to recover more of that revenue or account for more of it when we're selling. Again, beautiful thing about doing this process is you've got all this data in front of you and you can model some decisions. Well, what if we got our logistics as a percentage of revenue up? What if it really is 6%? And we can sell it that way? What would that do to things? All right. Now, so now we've got this all filled out. Everything's carried over. You can go back and you can massage an individual month. This is the data that we're working with. I want to go back and see what happens after September, that $1.1 million month that didn't happen, but we have a lot of business coming in the rest of the year. Well, there it is. October's got a $2.5 million revenue number on it. And this is a company that, $1 million month is a really good month. So that's a huge outlier month. And guess what? If I knew that month was coming, that's going to throw a lot of numbers off, right? Now I'm going to probably go back in here and do some massaging. Okay, I'm going to go back here and, there's a lot of trucking involved in doing that big show unless I'm lucky and it just happens to be in town. My sub rentals are probably going to go up quite a bit. And looky here, they've already come in here and they've jumped their sub rentals up for that month. So they've made a few adjustments here. They pushed their overtime way up. They left their outside labor the same, which I don't necessarily agree with, but I understand why they did it. And yeah, not much else they've changed here, right? But that's the point, is you can make some of these tweaks and have a better understanding of what kind of results you should really expect to get out of that month. Now, will their gross profit jump up this much as a percentage of revenue? It's entirely possible, particularly if they sell on value and don't sell on price. If they sell on price and they picked up a big show and they kind of cut their margins a little bit to get it, then we would see this number drop often very significantly. Usually what I would see in my average $10 million a year client, if they're normally doing, 50, 55% gross profit in a normal month, when they get to a month that's 2.5 times normal, their gross profit will probably drop down to something like 40%, which is still a lot of money when you think about it, but you're just not going to get the same results. All right, let's get back here and move on to the next thing, which is some best practices when you're doing forecasting. Okay, One, update your revenue forecast at least monthly, right? Constantly looking at revenue. And if you focus on revenue, you don't have to worry about the rest of the numbers because they just update, right? You can go into your forecast, you can, modify that October number from 2.5 down to the 1.9, which is much more realistic, blah, 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 blah. And all the numbers are going to change for you. Maybe you adjust your cost of goods sold ratios a little bit for the slightly smaller month. Which brings me to update your cost of goods sold ratios as trends suggest. If you find that your labor costs are running higher, as many of you have found through the course of this year, then I'm going to go in and be adjusting those costs of goods sold on labor. But it also suggests to me that I need to adjust my income numbers on labor, which means I need to charge more, not give quite so much labor away. And then overhead numbers, you adjust them when they change, right? You find out that you have an insurance bill that's going to be due and it's going to be higher than what you budgeted. Go in and change the number. That's what the numbers are there for. So keep up with that, tweak it, take a look at it, or spend a few minutes in it every month, and you'll find that the more time you spend in it, the faster you'll do the updates, and the less scary it will be overall. Now, the third piece of this is once I've got my budget forecast, it's going to populate my master sheet, which is where my monthly report comes from, right? So when I look at the monthly report, all the data comes from the master sheet, and I'm going to show you what that looks like now. So in the master sheet, every month when you close out the month and you export your P&L from QuickBooks for that month, you will take all those numbers and from Excel, you'll cut and paste and you will drop them into the column that they belong on the master sheet, and replace that with the estimate that's in there right now, which would be from the forecast, and replace it with the actuals. So you replace your forecast column with your actual numbers, and then you've got a couple of other columns you need to update because this spreadsheet is not sophisticated enough to do all of that for you. But for this sheet, this is very simple. This is not hard to do. Let me show it to you. All right, so we've looked at our monthly report. We've seen our annual forecast budget. So here is the master sheet, okay? Here is an actual month. So we're looking at a company that has got its financials through September. So January of this year, current year, would be actual numbers. February is actual. We get all the way up here to September, it's actual, and now we're back into forecast, and there's our $2.5 million September in our forecast. We also have our prior year months on here because remember, I need to have trailing 12 months data. I need to have prior year totals so that I can do some comparisons. All that data is here. What's very fun is I can go back and look at October of last year and say they've never done a $2.5 million October before. So we're into some uncharted territory, and their September budget, where they came out this year, was actually where they came out last year. So they may have some softness in their ability to forecast, right? But having all this data here at your fingertips makes it really easy. So when I close out October, I will simply cut and paste these numbers, this column from my P&L report that I export from QuickBooks, and I will drop them right in here. And I know there are some challenges in that things don't always line up, and there's some tricks of getting around all of that. And you can certainly modify the data before you cut and paste it in. But the long and the short of it is this is much easier than it sounds. So simply get the data to line up to your template, cut and paste it in, and do some updates. Now, I said you'd have to do a couple of updates. Once I've dropped that data in, I come back over here to the front and it changes my forecast. All right, so my current year forecast is going to be updated because it now includes accurate or the real data from another month. So that's going to affect my forecast because my forecast is everything this year, January through December. I just changed September. In this company's case, their forecast just went down from what it was last month, right? So they were at almost 12 million. It's now down to 11.5 because they missed their numbers. Here's my prior year number, which doesn't really change. There's nothing for me to update. My year to date does change, okay, because my year to date is now through September. The last time I looked at my current year, it was only through August. So I've got to move that number. I've got to redo that formula. My trailing 12 months is going to shift by 1 month. 1 month drops off, another month adds on. So again, I just shift that formula. My year to date, I just shift the formula, right? And this is easy stuff. You just go out and remove and add the pieces that you need. There are more sophisticated ways of doing this, I know, but if you can't do it, analog in Excel, how are you going to do it in SAP, right? So those are the updates and things that I need to do in an annual month. Everything else here looks exactly like what you've been looking at, right? The income numbers are exactly the same. The cost of goods sold are exactly the same. And this is not a sheet that I'm going to study because this is where my data comes from. So once I update the month and I update the year to dates and the trailing 12 months stuff, I'm done. Now I can go over to my monthly report and enjoy the results that are all in here, right? Pretty simple, pretty simple. All right, let's see what else I have to say about this. Get back to my, okay. So in that master sheet, couple things to remember. Don't let perfect get in the way of good. You're never going to have a perfect forecast. There is no such thing as a perfect forecast. Don't try, just try and get better at it. Don't leave any big goofball things in there that you know aren't going to happen. Learn from your estimating and forecast mistakes because you're going to make them. And it's just as big a mistake to underestimate as it is to overestimate. Again, there are two schools of thoughts there. Some people say, hey, we want to post some really big forecasts in there and keep that ring up high that we want to reach to. Other people want to, we call it sandbagging, put in really low forecasts so they can always beat them, so they can always pat themselves on the back. The fact of the matter is, when it comes to forecasting, both of those are fundamentally wrong because your forecast was incorrect. We want to keep the margin of error as low as possible so that we can make better management decisions. And when you're all said and done, the data from this year becomes the baseline for the next budgeting cycle. So as I'm wrapping up 2022 and I'm putting together 2023, boom, I start with 2022 and I've got the basis of my forecast. I'm just shifting some data on my sheets. I'm ready to go again. So it's very, very quick and easy. And once you get at this, and trust me, I know exactly how much time I spent building that spreadsheet from scratch because I wanted to make a new one. It took me less than 3 hours to build it from scratch. I'm going to give it to you. You're going to have it. You're going to save all that time. And you can spend a few hours learning how to adapt it for your business. And you've got a really powerful tool to work with here. Okay. Thank you. I already see questions coming in. Keep posting questions here. I'm going to pause and take this one really quick. How accurately should our QuickBooks P&L category names reflect the categories shown in the spreadsheet? They should be identical. Just make them identical. No confusion. Save yourself some grief. I can already hear our bookkeepers' objections to adding the additional information to the system. Yes, your bookkeepers are going to object, but this is your data. This is an important tool. That's like the dishwasher at at the restaurant complaining that the chef's knives are too sharp. No, make the tool better, right? I'll give you a good operational analogy as an old rental guy. On my pull sheet for my warehouse, I want the item that I'm pulling on my pick list. I want the name of that to exactly match the name on the road box. Okay, we don't need any room for interpretation, right? Make it as easy for yourself as possible to do that. And my apologies to bookkeepers. I did not mean to equate you or conflate you with dishwashers, but data is a tool, and let's make that tool the tool that we need. All right. Now, I know there should be questions about forecasting, and there always are. Look, you live in a dynamic world. Numbers are all over the place. You sometimes, and many of you tell me right now, it's more difficult than ever to forecast because you don't understand the customer buying cycles, lead times are shorter. Big jobs just drop in out of nowhere at the last minute. And it kind of makes you crazy, and I get that, right? Um, some timing tips here. One, when you have slow months in your budget, put projects in there. There are things that I know you're trying to get done, you haven't had time to do. Maybe you're going to redo your studio. Maybe you're going to get rid of your studio. Maybe you want to reorganize the warehouse. Some of those things cost money. Put that money in your budget. It would be horrible to say, hey, we're slow all July, but we didn't budget any money so that we could, fix things or, clean the floors or, replace the light fixtures. No, put that money in there. You're looking at your budget, you're looking at your entire year. Make sure you put some funds in there. Plan for hires, plan for payroll increases and CapEx spending. If I'm not going to do a whole CapEx thing right now, but there is a blog post on CapEx that's coming up in the next couple months. If you're going to spend $500,000 in CapEx this coming year, free up $250,000 in the first year and free up $250,000 in the second half of the year, assuming that you're hitting all of your numbers so that you can continue to make that investment. If you're going to do payroll increases, what time of the year are you going to implement them? When does that happen? Make that reflected in your budget forecast. You plan on hiring new help, or you furlough people over the summer, or whatever it might be, you can build all of that into your budget. Do accommodate the timing that you know for your business. And here's my favorite one, accruals. This is that thing about accruals again. Budget for things like company parties, employee bonuses, and other discretionary spending. Put that in there in advance. Put it in your budget and have your accountant or your bookkeeper accrue it. For instance, I want to spend at the end of the year, I want to spend $50,000 on the company dinner for Christmas. I don't want a $50,000 expense hitting my December P&L because December already looks horrible. So I want to feel better about December. So what am I going to do? I'm going to take $44,000 a month out of every month's budget and accrue that money. So I'll have a line in every month that says, employee thanks, $4,000 every single month, so that when I get to the end of the year, I haven't spent any of that money. I've saved it up on my P&L. So you can do these things with your budget. When I talk about finding these little Christmas gifts for yourself, when you do accruals on things like warehouse expenses and office expenses and bonuses and things, there's going to be money there that you didn't actually use along the way. So you're going to build up this little fund. And if you have to pull some of it back because you didn't hit your numbers and you're falling a little bit behind your 20% net profit goal, well, there's some of that money right there. And it's not just on things that are discretionary expending nice things that we do for each other. There's also discretionary spending saying, hey, for instance, on my old job, I gave my warehouse manager $5,000 a month to spend on anything that they thought was important to make the warehouse run better. If they wanted new shelves, if they wanted to save up for a new forklift or a pallet jack or anything like that, they had budget to do that. And very often they wouldn't spend it because it was a generous amount for them to do, but it was there in case we need it. Well, I can roll that money back in. Come January, he's still going to have $5,000, but at the end of the year, I got $18,000 left over. We're going to put that back into the P&L, and that's going to help fund things like bonuses and raises for next year. So great things that you can do with your timing that way. So the point of all of this is fiscal budget is the same as planning, and we make a plan so we can change it, right? You don't budget because you want to tie your hands. You budget because you want to free yourself up. And this is how we do it. So this will bring your budgeting up to the next level. And then you can start improving it from there. So I see some questions coming in on chat. And I see those. I'll get to them. If you can put your other questions in the Q&A box, that would be awesome. Next month's webinar, yay, lessons from 2022, what to expect next. I'm going to put a lot of Q&A time in there. So if you've got some big questions, that you want to bring to next month's webinar, I'm going to be ready to answer them. This is kind of that Ask Tom with a pretty good sized preamble. But some great lessons from this year that we want to carry forward into next year with what to expect. Replays. Well, as you all know, you'll get an email here in the next hour or two where with a link to the replay of today's webinar, a link to that spreadsheet that I've been sharing with you, and you will also be able to find it over at intentionalsuccess.biz, probably sooner than you'll actually see the email. All the webinars are archived there, so if you want to go back and watch some old webinars, want to see how my hair has not changed in the past 10 years, well, it's all the evidence is right there. If you want to talk to me, hey, go to the website, click on the Let's Talk, and let's have a conversation, right? There's, if you need help with this, or if you've tried this and it's not worked the way that you expected it to, whatever questions you might have, bring them to me. Happy to talk about how we can work together, or I'm happy just to answer some of your questions. Quick summary. Invest in your budgeting. Invest in this forecasting process. It is worth the time and effort. I enjoy it. I think this is exciting. I think this is like the coolest thing since sliced bread. And once this became part of my management life, it was life-changing, right? There's just so much more that you can get done when you understand the numbers and what the implications are. Your decision making improves dramatically, and it allows you to be not only strategic but innovative, and it allows you to say yes more often, because really saying yes is what being a manager is all about, is finding the way to say yes. All right, let's see what we can do here about some questions. I'm going to get rid of the share, and you can look at my mug instead. And question. Okay, if our company's been in existence for 20 plus years, what are the risks of recategorizing financial statement categories? Blah, 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 blah. What are the challenges should be prepared in losing historical comparisons? Negligible. All right. So yeah, and I run into this a lot. If you've been running the same financial statements for 20 years, I mean, when was the last time you cared what your 2019 numbers were? You don't. So it's okay to change the stuff. A matter of fact, you should update it fairly regularly. Now, you don't lose the historical data, you just compare it differently. For instance, if I need to compare my new P&L with my old P&L, again, get it out of QuickBooks. You've got it in a spreadsheet. You can map it to your old P&L. If you used to have a labor number and now you have 5 labor numbers, great. You're doing a comparison with labor number, 4 empty lines, and then 5 lines next to it. So you can set all of that up for the time that you need it. I've been involved in a lot of merger acquisition stuff over the years. It's very rare to find somebody who's got 5 years of financials that line up exactly the same. Your business changes and it evolves. So it's a past thing. It's a historical comparison. You can still do the historical comparisons if and when it's actually important. But I wouldn't hold myself in the past, because I might want to see that comparison exactly the same way. All right, forecasting, how? Okay, thank you. All right, I should expect this question, and we got a couple minutes, so I'll give you the quick primer on how to create your forecast. For instance, if you're sitting down trying to forecast 2023, let me make it easy for you. Start with your 2022 numbers, then normalize them. You have outliers in 2022. You have big jobs that are never going to happen again. You don't know where they come from. You could never reproduce them. Pull that number out of there. If you had a $500,000 job in May that you don't expect to happen again, if you hadn't had that job, what would you have sold instead? Well, you might have sold $100,000 or $200,000 of other business that you turned down. Add that number back in. So if your May was $1.2 million because you had a $500,000 outlier in there, and your normal May is $700,000 or $800,000, great, just make that adjustment. So normalize the prior year, just get the noise out, right? Now, you already have some outliers for next year. Well, you need to add those in. So say, for instance, you've got an outlier in February for a $500,000 show. Well, great. I'll take my normal February, I'll remove some of it because that $500,000 show is going to eat up some capacity. You decide how much, and now I've got a number for February, right? If you are making an effort at doing something, for instance, if you analyze your 2022 numbers and say, hey, 60% of our transactions was only 10% of our revenue, which means we did a lot of really small jobs. That took up a lot of time and energy, not a lot of return. It's not the focus of your business anymore. You plan on phasing it out. If you've got a plan for doing that, okay, include that in your forecast. If I wanted to get rid of, a small chunk of my business, which was not a high return and was a high labor intensity, I'm just going to raise those prices. Piece of cake. You raise those prices, you're going to reduce that number by 50%. You're going to save some money in the long run. It's going to affect your cost of goods sold. You put all of that in your forecast. Great. So that's the way to forecast from your current base of knowledge. There are other methodologies that will get you there. None of them include, we're going to grow 10% and add 10% to all the numbers. That does not exist. That is not math. That's guessing, and that's not even good guessing. So make sure that you're using something that you know. Normalize the year, put the outliers in or out that you know about, and then put a result from your effort for whatever it is that you're trying to do to improve a number or de-emphasize a number to get to those results. And then again, be ready to update it, right? Get that 20% net profit though. All right, next question. Good on time. I got time for 2 more questions. Do you need to break down so many income categories? All right. So what you saw on my template was a pretty conservative list. I've got clients who have 40 income categories. I have clients that have 10 income categories. If there is a corresponding cost to any kind of income, you need to break it out separately. If you care about it in cost of goods sold, then you need to track it independently in revenue. That's the rule of thumb. So if you sold it, if you're going to incur a cost, track it separately. Now, do all of your travel costs need to be broken down by this is room service and this was a meal in a restaurant and this was fast food? No, of course not. You can still use common sense. If you can capture it in per diem instead of itemized expenses, more power to you. So find a way to make some common sense decisions about this, but many of you need more categories in revenue to have a better understanding of how your business works. And last question, easy. Okay, why don't you compare months? Well, you're a seasonal business, right? September this year has nothing to do with September last year. Yes, was that the basis of our forecast? Only from the standpoint of that's your capacity. There's a point in time when you quit selling and you start getting nervous about selling anything else. You felt that a lot this year. That's going to affect your revenue numbers. It's not really the months. So I don't really compare the months unless it's helpful for me to compare a month that has a similar revenue number but got different results, and I want to understand why my results were different this time. So in that case, I may go compare $2 million months and see what the differences are and see if it was the mix of client, the mix of revenue, maybe this was in town, more out of town, that sort of thing. That's very helpful. Yeah, so that's a good answer for that. All right, so thank you. Speculation of 2023 recession, how do you estimate this in budgeting? There, other than the 2007 recession, which was not a recession, it was much bigger than that. Recessions typically don't have a major impact on the events industry. We will have to see, but if you are running low overhead, right? And you're not staffing for busy months, if you have a dip in revenue because of recession, if you have a quarter lull, okay, chances are that lull is not going to be go below what your overhead threshold is designed to support, right? So keep your overhead low, and you have really nothing to be afraid of about a dip in revenue for a few months. You're going to coast right through it. Yeah, you may not make a lot of money those 3 months, but you're not going to lose money. It's not going to be like May of 2020. All right, good chat. Thank you guys for being here. It's been my pleasure. And if you got more questions, just shoot me an email, set up a call. I look forward to talking to you. Everybody be well. Cheers and happy Thanksgiving.